Hi, everyone. I'm here with Campbell Harvey, and Campbell has been on the Compound channel before. The last time Campbell was here was this past fall, talking about the yield curve indicator, which is an economic indicator that he pretty much invented, discovered, and has been right 7 out of 7 times in being able to predict recession. This is the eighth time, it appears. So Campbell's indicator is undefeated. We're going to talk about how he knew he was right this past fall and what he told us on the Compound, and what he thinks about the current environment, how we should be thinking about what we're going through, the way forward, when it might end, etc. So Campbell, welcome to the Compound once again.
Great to be back.
I want to stick with, first of all, what we were talking about from last fall, and we have a clip. Let's just show the clip really quickly.
It is inverted before the last 7 recessions, and it hasn't rendered a false signal. So right now, people are looking at it very seriously. The track record's impressive. It's flashing code red since June the 30th.
Okay, so look how handsome you are, first of all, in that clip. Still handsome. And you're in North Carolina right now?
I'm in North Carolina at my home.
Okay. And you're a partner at Research Affiliates?
That is correct.
Okay. And what do you do at Duke University? Give everyone your official title.
Yeah, so I'm a professor of finance at Duke University.
Okay. And you've been there for how long?
A few years, yes.
Okay. All right. So last fall, you were basically talking about this idea that when the yield curve inverts, it's not a matter of if we'll have a recession, it's a matter of when. And you are now 8 for 8. So the indicator that you came up with in 1986 in the process of doing a dissertation is now undefeated for almost 4 full decades. First of all, how do you feel about that? How do you feel about your creation and how it's endured for this long?
Well, actually, you always want a false signal. Nobody wants a recession. So right. You have to be objective about it. Look, it was code red June 30th of 2019. And the recession indicator by the yield curve wasn't the only thing that was pointing to a recession. We had a recovery that was historically long, more than 10 years. Looking back to 1850, we hadn't had anything like that. And the longer the recovery, the higher the probability there'll be a downturn. On top of that, the Duke CFO survey, 50% of CFOs thought there'd be a recession in 2020, and that went to 80% if you included the first quarter of 2021. So there was a widespread perception there was going to be a recession, and I certainly hope that that CFOs and CEOs and consumers took that message and became a little more frugal, because then obviously the COVID-19 hit. Obviously, my indicator is not forecasting a pandemic. The pandemic just happened. We will never know if a recession would have happened if there was no pandemic.
Well, let's back up, because that's very important. You did not come on in October and say there was going to be a pandemic from Wuhan, China, that's going to spread across the world and cause a recession. What you basically were saying was, look, the market signals, the bond market signals are telling us that risk aversion is already on the rise and doubts about future economic growth are already here. And so what is the trigger for the recession? I don't know, but I know based on prior instances of yield curve inversion, we're on a code red right now, and that trigger will become apparent soon. I mean, that you were right.
Yeah. So again, it is 8 out of 8. It's also important to note that there hasn't been a false signal yet. So no false signals. So you can get 8 out of 8, but then have like 8 false signals. So you have 16 signals and 8 of them are correct. So I think that's important also. Again, the pandemic event is nothing that the yield curve was forecasting, but you're correct that the flight to safety, the flight to quality was going on in 2019. people were expecting something to happen, either a recession or much slower growth,
It
and then
just
we
wasn't
got walloped
right.
with the
It just
COVID.
wasn't showing up in the S&P 500 because
Uh,
the companies that dominate the S&P were going to do fine either way. So that
yeah,
fear was elsewhere.
so exactly. You can't just look at the stock market. The stock market is an unreliable indicator of a future recession. We've seen so many false signals both ways, where you go into a drawdown and then there's no recession. Or the market's at an all-time high and then you go into a recession.
Yeah.
So the stock market is a much less clean indicator, even though it's strongly influenced, obviously, by economic activity, is just an unreliable indicator of future economic growth.
I want to back up really quickly and do two things. I want to get a quick definition from you on the yield curve indicator for people that may not be particularly focused on economics and haven't come across that before. And then I want you to just walk us through the timeline of when your indicator was triggered and how long until recession in this particular instance and where that falls historically. So first of all, somebody came up to you on the street and said, I'm not an economics student. What is the yield curve indicator? What's the easiest way to explain that for people?
Yeah, sure. So the yield curve is simply the difference between a long-term interest rate and a short-term interest rate. And in my dissertation in 1986, I looked at a 10-year Treasury yield relative to a 3-month Treasury bill yield.
Okay.
So usually it's the case that longer-term interest rates are higher than short-term rates. We see
Right.
this all the time, except in certain periods of great uncertainty where you see the reverse. So the long-term rate actually goes below the short-term rate. So that's unusual. And my dissertation showed that that was actually a very accurate forecaster of a future recession.
Okay.
So,
So,
and
so
this
for
happens before the recession, well before the recession.
so for someone watching, that makes intuitive sense. If I lend you money for 3 months, the interest rate that you're paying me on that loan should be lower than if I lend you money for 10 years because I'm taking more of a risk saying pay me back in 10 years, so you should be paying me a higher interest rate to lock up my money for that long. So that makes intuitive sense for people. And then when that reverses, it's telling you people are way less confident about the economy further out than 3 months.
Exactly,
Okay.
and the indicator is very clean, and indeed most of the action in the inversion in 2019. So this was happening in the second quarter of
June
2019.
30th was like the trigger.
Yeah, so June 30th is the end of the quarter, and my indicator requires that the inversion not just one day, but there's an average of an inversion over a full quarter.
Okay.
So that's the June 30th date where I went on the record saying code red.
All right. Well, you nailed it. And, one of the things that Michael Batnick and I tried to do in that conversation was to give you all the reasons why people say, don't worry about the yield curve indicator. And I think you successfully had a good response for each of those reasons. It was fun playing devil's advocate with you. And so I think people should go back and watch that. I want to ask you a couple of things about the pandemic, the situation we're in now, but I just want one follow-up question on fixed income. Is the yield curve indicator going forward going to be hampered by the absolute level of interest rates? So the Fed has basically gone back to zero now. Does that make the signal tougher to read or less relevant, or is it even more important than ever? Like, what do you think about your indicator in an abnormal period of time like the one that we're in for rates?
So I would say, and the answer to this question is not, it's not easy to answer because it depends on the sort of scenario that we go to. If we go to a Japan-like scenario where essentially the only buyer of Japanese government bonds is the Bank of Japan, then I believe that the yield curve indicator would become not useful. So if we go to that scenario, I'm very worried.
Okay.
We're not there yet, even though the
Okay.
Fed has strongly intervened in markets. But as we talked about last time, the Fed has intervened before. And
Sure.
indeed, the Fed was relatively more powerful in terms of the yield curve in 1960s and 1970s. So the Fed is always going to be adding noise to this indicator. So I would say going forward, given the history, that the yield curve will be an accurate indicator with the proviso that we don't go into a Japan-like situation. Indeed, the
Okay.
yield curve today is upward sloping, suggesting that there will be economic growth. We'll be out of this recession relatively quickly.
All right. So let's talk about that because I think people really want to hear your take on the situation we're in and what you think these types of signals might be telling us about the market's expectations for how long it goes on, how much worse does it get, when does it improve. So what are your thoughts on the topic?
Yeah, so this recession is totally different than the last 7 recessions in that
I would say.
its cause is biological. That's the key
Right.
difference. So the
Right.
global financial crisis, the cause was a structural problem with our economy. Our banks were acting like hedge funds with extreme leverage, and a small financial event caused a breakdown of the entire system and a recession that was long, painful, and even when it was technically over, we didn't know it was over. So
Yeah.
unemployment peaked after the recession was actually over, and we didn't get back to the level of unemployment that we had in 2007 until 2000. It was like 9 years later, so
So
2016.
yeah,
So
this
it
the
lasted
stock
for this.
market. Right. The stock market bottomed in March of 2009. Unemployment kept getting worse until I
Right,
think the peak was September or October of 2009. And
right.
then the stock market, you don't get a new high until March 2013. And GDP takes longer to recover. Right. So it's a balance sheet recession. It's a busted debt bubble. It's very, very different. This is almost more like this is my opinion. Maybe you don't agree. This to me feels more like it's a natural disaster driven recession. And no two are the same, but we have examples of those. The big example that everyone thinks about is the earthquake in 1906, where the rescue effort cost a lot of federal money. Didn't really affect people living across the country, but it was a market event. I don't know what's your take on this being a natural disaster driven recession more than a financial recession?
Yeah, so this is like a key insight. So in the global financial crisis, we didn't know when it was going to end. So it just went on and on. The policymakers kept interest rates low for an abnormal amount of time. It just went on to uncertainty. So companies didn't want to hire people. Companies didn't want to make capital investment because they didn't know when it was going to end. So what you're saying about natural disaster is exactly appropriate. So there is an end to this crisis, and the end is triggered by another biological event. And that is a pharmacological solution to mitigate the fatality rate or a vaccine. And people fully expect, and I think financial players in the market fully expect that a vaccine will be deployed by the first quarter of 2021. So you see that there's an end to this, and the vaccine is literally an all clear. It's a little different than an earthquake because earthquake hits, maybe there's some aftershocks, but it's over. This one is longer because we actually need to find a cure in terms of the biological problem.
All right, so put the natural disaster comparison aside. What about this one? People say this is like 9/11, but daily for 9 months. That's very dire. But is there some validity to that metaphor or not really?
Yeah, I don't think so. And let me
Okay.
tell you why. So 9/11 is kind of analogous to right at the beginning of this crisis, where there was a large amount of uncertainty. We saw these exponential curves in terms of new cases and death rates, and people extrapolated that it could be incredibly dire with millions and millions of people dying. So we now have become knowledgeable about epidemiology and the sort of curves that are common for viruses and stuff like
I'm practically a doctor now.
yeah,
Right.
yeah, everybody has to be. So if you're in finance, given the nature of this crisis, you need to understand the basic concepts of epidemiology. So you need to understand what flattening the curve actually means. You need to understand what's going on in terms of the clinical trials. This is crucial for finance. So everybody needs to be schooled in this. So I do think that it's different now in that we do have this expectation. We've got a number of actually good news items for a change in terms of the biological progress. And I think that indicates that this will be obviously historically unusual recession in that the drawdown is so fast. I call it the Great Compression, where you get essentially the unemployment of an entire longer recession in one quarter.
This might be the only recession in history where the entire world agrees on the start date in real time. When Adam Silver canceled the NBA season, I think maybe it was like a night in early March or maybe late February, but it was like that one moment where everyone said, okay, this is the real deal. Life as we know it is over. And the stock market repriced for that. In 20 days, we lost 30%. So it was like the first recession ever where everyone just automatically agrees, oh yeah, recession, that's it. Usually it takes months for everyone to agree.
No, not months. It could be even longer. So it's the official people that date the recessions. It's the National Bureau of Economic Research. And sometimes they date the beginning of the recession after the recession's over. That's the sort of lag that you look at. So this one, you're exactly correct. It will be the easiest recession to date in the history of all of the dating.
March 2020, that's it.
Yeah, or February.
Discussion.
Yeah, so February would be the peak.
February.
And it starts in March. Yeah.
Right. So let me ask you this then. People that are bearish right now would say, no. Even if we have a vaccine in January of 2021, which, by the way, is not a slam dunk, but let's concede there will be a vaccine. We're not going to have 500 million doses of it. Maybe we'll have enough immunity that people aren't afraid. But that ramping will take time. Even if you get it approved, we know it works. We think it works. So that's a hurdle. And then how much damage is done between now and then that can never be recovered from on an individual level? And then aggregate all of those individuals who, vaccine or not, are never getting their business back. That, like, to me, that is the thing to be I'm not worried that we'll scientifically solve for this virus. I'm worried if the damage is irreparable and we take on so much debt while that damage is occurring that the recovery is 10 years from now instead of 2 years. Am I worried about the wrong thing?
Yeah, so that's the pessimistic scenario, the L-shaped, the lost decade.
Yeah.
Look, the cost is enormous. I think our policymakers are realizing this. I think we'll take the lead of other countries. For example, the University of Oxford has got a vaccine in trial, got 1,100 people. They're going to expand it to 6,000 in May. They just contracted with AstraZeneca to produce the vaccine that they're basically it's in trial. So we don't know.
Unheard of.
So they want to deploy in September. So our policymakers need to do the same. If there are 4 candidates and we have a trial that just began,
make them all.
So produce it.
Yeah,
so produce it, have it ready, and so we can deploy it. Because basically delaying 1 quarter is just enormously costly. We're talking over $1 trillion. And surely that $1 trillion is much more costly than actually producing vaccine, which a large part of it we might need to discard. That's fine. That's a simple cost-benefit analysis. Look, what you're talking about is the potential structural damage to the economy if this goes on too long. And this is a very good point, and I've been very vocal on this. that in the global financial crisis, we had to bail out banks that were offside. They did poor risk management, and we effectively were rewarding bad behavior. In this natural disaster type of recession, we've got firms that have been hit hard that were high quality firms.
Yeah.
And many small businesses also, 30.2 million small businesses in the US that account for 49% of the employment. So what our policymakers need to do is to mitigate the chance that these businesses that are high quality go under. We'll see bankruptcies, and many of the initial bankruptcies
No
are
matter what.
firms that were probably headed there anyways.
Okay. So it's an accelerant for weak firms in some cases, and it's also been an accelerant for some of the technological trends that have already been enforced, like virtualization and meeting without meeting. So it's accelerating some things also. I think that's a good point. There's two more things I want to get to with you, and we so much appreciate you joining us for this. The first is Nassim Taleb has gone out of his way to correct the media who are repeatedly using the term black swan. There is nothing black swanish about a pandemic. We've had pandemics since the dawn of time. You make the case that it's not the virus that's the pandemic, it's the government-mandated shutdown of all economic activity. That's the black swan. I think that's a really important distinction. Can you talk a little bit about that?
Yeah, sure. So I totally agree that people calling this black swan just false, in that we've got a long history. And it's not just the pandemic of 1918. Look at what happened in 2003 with SARS, the MERS, Ebola, HIV. There's a long list. And indeed,
And that's
many
before we
companies,
even go medieval, right?
yeah,
But there's a long list of
exactly, this is
modern.
recent.
Yeah, agree.
So bird flu, swine flu, all this stuff has been in the news a long time. So this is definitely not a black swan, but the lockdown absolutely is.
Right.
So we've never seen numbers. When that initial claims number came out, that was 3.3 million, where the next largest historically was like 375,000. That was like 170 standard deviations.
And then it went
So
up.
yeah, it was crazy number. And then it went up even further.
Yeah.
So we've never seen anything like this, but, and this is important, because it's compressed, we've seen these historically large jumps in unemployment. We will also see historically large jumps down.
We're at probably 20% unemployment, which it took you 2 or 3 years to get there in the last recession. Like we've had an entire recession's worth of job loss. The question is, how many of these are lost jobs versus temporarily put off jobs that are coming right back? I don't think you think it's 100%, but if it's
No.
80%, isn't that great?
Yeah, so look at it this way. In the global financial crisis, you worked for Lehman Brothers, you lost your job, it was gone. And indeed, really hard to find another job in that particular sector, given that what was going on. So the word is furlough. So it's a different type of work where people told, well, you're furloughed for 2 months or
Keep
3
your
months.
benefits, and we'll take you back.
Yeah, and maybe we'll take you back earlier. It just depends. So
Yeah.
the psychology is even different. And given that the firms that are furloughing, most of them high quality firms, profitable firms, there's a reasonable expectation that you can go back. Again, the key thing is not to inflict structural damage, whereby if this goes on too long, then some of those high quality firms go away. And that is stuff that will lead to slower growth in the future. So we don't want that. We don't want firms that were very profitable going under. Other firms might be created afterwards, but there's a lot of fixed cost and startup costs to get that to happen.
So the faster there's a medical solution, the less danger there is of furloughs becoming permanently lost jobs and frozen businesses becoming dead businesses. And I
But
think we all agree it's what we want.
it's not just the medical or biological solution. I think we could do much better in terms of strategically having different policies for different areas. Obviously, the density of New York City is different than the density in Durham, North Carolina. So we need to tailor the policies to particular areas. We need to recognize the heterogeneity. We need to basically test and accurately test. We need to trace. If somebody is infected, isolate, and anybody that's traced should be quarantined. That's a smart policy. To have one kind of blanket policy of lockdown is really destructive.
Well, it doesn't work, and it's not being enforced anyway. So you're right. And I think as the weather gets nicer, it's going to be harder and harder to keep people living like they're in Midtown Manhattan when they're not. So I'm with you on that. Um,
Yeah.
Campbell, I want to thank you so much for joining us. You do great work on behalf of Research Affiliates, and anytime I read anything that you've written, I make sure I sit down and I really digest it. And I think your work on the yield curve has been really insightful. And I hope you'll come back as the economy recovers and we have a in-person follow up to this at some point soon. But thank you so much for joining us. Guys, let us know what your thoughts are. Leave us comments, leave us feedback. Go ahead and subscribe to the channel if you haven't already. We will be back very soon.